Hey, welcome back. This is Felix Fry. We have Rob Bendock.
Hey guys,
All right, good. We're going to talk today about options flow and Citadel payment for order flow, maybe a little bit, and anything else that comes to mind. So I wanted you to start, Rob, because you had an experience trading with brokers before I was even involved in
right.
1995, so in the early 90s. So why don't you take it from there and tell us a little bit? Because we want to help people understand today where this all came from. We didn't have apps to just trade any security, anytime, anywhere in the world, from your fingertips on your phone. So tell us a little bit about your experience coming in.
I mean, I began in the operations side of the business for a gold trading company based out of London and in the New York office. And one day I had the great opportunity to meet a let's call him short Hungarian gentleman by the name of Thomas Petterfy, who
Oh,
eventually
wow.
the interactive brokers had the chance to sit on that desk. Really was more of an automated response. You would follow the guidance from the machine or from the desktop in order to execute. But spending that time made me realize that there was a future in electronic trading or electronic market making. It wasn't adapted to the overall marketplace, and a lot of people didn't like the guy because they thought it was an edge using the system. But lo and
That's
behold,
incredible. Hold on one second. What year was this?
I think I met Tom in 85 or 80. I think 85 is when I met him.
Wow. And he had tablets already.
He had handhelds. He had a screen on his first foray. He had handhelds.
Right.
And I believe the exchange gave him a hard time and said, well, you need to display these on a screen so everybody can look at them. And Tom made them color coded. So it working for him, you knew what the color
This
codes were.
was, I mean, this is really, really early. 1980, 85 is really early for electronics to be used.
His first device was a handheld. There was some objection to it by several of the exchanges, if my memory serves me correct. And then Tom put up big displays in the corner of the options pit. And the colors, the markets were denoted by color bands. And those color bands gave you the month to strike your bid and your offer. So it was kind of like, watching TV, if you will, but having some instinct to be able to realize that those screens there was some latency, and
This
they
is incredible.
yeah.
I have so many questions. One more question.
Mhm.
There's no Wi-Fi at this point. This was a calculator basically as a handheld. Is that what we're saying?
On the screens it was it the handhelds, although I'd never used one, they were powered by a giant battery pack, and that took into consideration
Who was carrying the battery in the
other
back?
guy that's
It's like
on
a
the
NASA. Oh,
market
the
maker.
guys had a battery back on.
It was again, I never did it, but the
Okay,
pictures.
so it's a mini computer handheld.
Yeah,
And okay, so no Wi-Fi, because Wi-Fi didn't exist at the time. So
correct.
I don't think in 1985, I don't
I don't
remember
believe
Wi-Fi.
either.
Okay, so walk me through. How long were you with this group?
I spent about 4 years with Tom, and then I went on to work as a local or a market maker with two different entities. So backed with capital, you get a draw and then a percentage of a percentage of the earnings that you bring in. And you look at a market where volatility just collapses, and I think the VIX was sub 10 when I decided to leave. Um, it's really hard to consider selling premium to make a living when you sell quarter or fraction options, quarter, five teenies, three eighths. I mean,
Right.
there was money, but there was also a tremendous amount of risk. And
Tell us more about, okay, so it's the late 80s, early 90s. How
yeah,
much volume was coming in and what was the bid offer like? And what were the big products that were trading? Was it just the top 10 names, all names?
well, I stood in the XMI, which is the major market index pit, and that was basically the Dow stocks, the top 30, if I recall, the 30 that comprised the Dow. And let's say it was an at the money put with a month left, it might be a half a dollar wide, a three and
Wow.
a half, or 3 5/8, 7/8, 3 5/8, 4. But when you think about that, that's 37.5 cents bid offer spread on, a $3.50 option.
10%.
Yeah,
Yeah,
10%.
10%. Yeah.
So there was an opportunity for people to be able to, buy and sell and hedge their positions. But there was also orders that resided if the broker that wanted to trade, okay, that's 3 5/8, 7/8. I'm a 3 1/4 bid. So the broker would leave that if he had a limit order, put it on the book. And then if the market came back, to that level, okay, 3 3/8, 5/8, 3 1/4 a half, 3 1/4 bid on the book for 50 contracts. That bid was there, and a market maker could kind of lean on it, if you will, and take advantage of it if the hedge went the proper way and just hit that bid. So it was completely different than what it is now.
Back then, so people understand the broker. So the traders, the market maker had good power, but the broker had enormous amount of power down there, especially if your account was, Goldman Sachs, Morgan Stanley, the leaders of the derivative era at that time.
Yeah.
If you were their broker coming in, they had the biggest orders. And the biggest orders, you said lean on, for everyone understanding what that means, is lean on is essentially a legal way to sort of front run, if you will, almost an order, right? It's a way to say, okay, someone's buying calls, he's going to bid, I'm just going to buy some stock, and then I can lean on that order, right? Buying some stock and then selling him those calls up an eighth or up a quarter or up 3/8, wherever the market's going to be. Or if if he's about to pull it, I might just hit him at where he's at, so I can just lean on that by buying stock. And that went all the way up until I mean, 2000. They changed some rules in about 2004, 2005 when I
Yes.
was there. We can go into that, but that whole, the pits were made of a bunch of was made of market makers, but also traders that were just hanging. You paid a little bit of money to be able to stand there, and
Yeah.
then you made money from the order flow coming in from different angles, and and some of these people never even traded options, really. They just were trading a lot of stock around these options, just kind of floating around.
Right. And the interesting thing is the SIBO was pure open outcry. It was best bid, best offer, fastest guy or fastest gal. With the American exchange, it was a specialist system. So it was split up, front month. So let's say we're in July now. So let's say August and September. And then that would be for the put market. And then it would be the same thing for the further out. And then the shorter dated call and the longer dated call options. So the broker would go into the specialist, ask for the market. He or she would have his his buyer seller. Let me get that in there. This is most people I don't think will have ever seen it. So they walk in with a ticket, and the ticket says buy or sell, and they have all the instructions on it. If it's a limit order, if it's a market order, whatever it might be. And then the specialist would say, okay, it's 3 1/4 a half. I'm a 3 3/8 bid. Okay, 3 3/8 a half, 3 3/8 bid for 250 here at a half. Okay, 3 3/8 bid sold. They trade 3 3/8. One market maker could hit them or two market makers. And there was a great old line that said share, that's fair. If you tied on it, if you were both really quick. And so you split it. And that was
And then what did you do with the ticket? So the ticket has to go somewhere. So now the ticket you put in a box. I remember in the movie Wall Street, I think it was, or one of these. What was I know with Jordan Belfort when he went back in time and he was like he's with Matthew McConaughey and they're taking a ticket and they're dropping it in this like.
I think that was that was a different. I think that was the exercise box that we can go into. But what would happen is you would write your ticket, and then you would stamp it, and you would go to a reporter. And if you were the aggressor, if you were the seller, you would stamp that ticket and make sure that it got put through the line, which was really like a conveyor belt, got sent in, and then it would go to the screens and be posted. And it really,
How long did that take to give us?
it took a heck of a lot longer than the response time today for sure.
And
But
there's a lot of room for error. There's a lot of room for error, and then you got to put it back in and adjust.
exactly, because let's face it, that print was the Bible or the doctrine of the day's activity. And you wanted to make sure that your transaction was printed, it was printed appropriately with the size and the price. And that way, if you ever had what was called a an out trade or a DK, a don't know, the next morning, the contra broker, you can go back to the tape and look at it. You can look at each other's tickets, and then you would come up with some.
What a system. Okay, you have this archaic system. Let's move to 1995. Felix enters the business, so I know a little bit more. But 1997, 8, 99, bull market, roaring. You're on the desk. I looked at you as a fairly senior person already on the desk and dealing with accounts. Describe sort of the differences that you saw in 1998, 99, market ripping, but the system is oiled now. The volume in the SIBO in 1995, I think, was 150 million contracts per year, 1995.
Yes.
150 million per year. To
Here.
give you some context, right now it's like 12 billion a year, something like that, right? So the amount that the derivative market has grown since 1995 to today is incredible.
Right. Well, it became an incredibly well-oiled machine for a handful of reasons. Number one, the number of firms that were actively involved in trading options or trading listed derivatives or trading OTC derivatives in equities or indices, it grew, and there were a handful of people, of one of which we both worked for, that was probably the best in the business. And the reason being is the gentlemen that were there, they came from the floor and they
Yeah.
understood the pricing methodology. They understood how to do this. And when they had a screen in front of them and they were able, like the regular display on their desk, nothing outlandish, but they were able to ascertain very, very quickly, is this fair value? Is it theoretical value? Is it above or below? What are we looking at? And then make that determination pretty quickly on whether to buy, sell, or counter the bidder offer. And then you began to see the use of options by mutual funds, which I was a part of. It took a reasonably long period of time to convince people that this is additive to your portfolio. And one of the arguments or one of the conversations was that, listen, you're managing people's money. You're managing their 401k, their 529 account, all these hopes and dreams funds that they have. But in your personal life, you have life insurance, you have homeowners insurance, you have car insurance, you have health insurance. So you mitigate the risk in your personal life by instituting a hedge or a policy, insurance. Even though options can't really be called insurance, they are a hedge against a significant decline in the market, if that's the way you want to posture it. And then it kind of made sense to a lot of people. Well, what's the benchmark? The benchmark is 11.5%. Well, we're up 19. Maybe we spend 25 or 50 basis points to hedge out to the end of the year. And then it became a little bit more.
During the 90s, I remember it was very much a teaching process. I remember
100%.
going out on calls with senior salespeople, and it was hand holding, explaining what you just said, how to hedge, what options can be used for, how to mitigate risk reward. It wasn't like everyone knew what this product was. It was still a lot of teaching going on, and the mutual funds, a lot of them like the idea of selling. The longer term thinkers, they like the idea of selling options, and the hedge funds were in there really buying the options. They were coming in there for the leverage. And
Correct.
so these two customers, different customers with different ideas of how to use the product coming into us. Some were selling, some were buying, and then you had the traders who were market making upstairs. And I mean, the O'Connor trading team was one of the best, if not the best, considered the best. over the years, and very smart guys, and they they were incredible at what they did and how fast they did it. I've seen so when in the pits in Chicago, the O'Connor market maker was always the guy that or gal that people looked towards because everybody was looking to make a market. They were just the fastest. The other team that was very, very good was Susquehanna.
Mhm.
Susquehanna on the East Coast was as good as O'Connor was in the Midwest. And so you had these two big players that controlled a lot of the market making on the floor. And then O'Connor came upstairs in the 90s because they were
Right.
bought out by Swiss Bank. And then Susquehanna basically Susquehanna was the beginning of payment for order flow. A lot of people don't know this. So Susquehanna came in the 90s, the late 90s. I think I had left already your side. I sat next to you and I had left already to
Yeah.
go work at Bank of America. And that's when Susquehanna was really building out their payment for order flow before Citadel, before the big, options market makers that we hear about today.
I'm looking for this one piece that I saw and read, and one of the things that was brought up was that the payment for order flow was actually started by Bernie Madoff.
Is that right?
I mean, I read the article off of a very, very noteworthy publisher that I wouldn't think they had anything
That's
to.
interesting. Yeah, that's interesting. Well, maybe in I mean he trade supposedly I don't think he traded anything, but he was trading options. But I think the payment for order flow, um, it might have been for stocks, maybe. I don't know. I don't know.
It
I don't know
probably
that.
was. Yeah, yeah.
But as far as I
Go
was
ahead.
gonna say, as far as Susquehanna, they were paying the big investment banks good money for their order flow, and they were the market makers on every stock, and they were big traders. They were size up and they wanted to trade and they wanted the business and they would pay you to give them the show first, which
Right,
was really interesting. And that was where a lot of the investment banks started laying off that risk. So what's important for everyone to understand is that, options, when everyone's buying options or selling options, well, people are market making. The problem is if you're a market maker, you're dealing with, say, Microsoft options, which means you get to see every single Microsoft option that comes into the world, right? That you get to see it, pass, let other people join in, whatever. You're controlling Microsoft, one person. But when you're and you're the market maker, when you're an investment banker and you are trading tech, Microsoft is one name out of 100.
mhm,
And it's not like you're focused because customers are coming in and saying, I want to do Apple options. I want to do Microsoft options. I want to do, and back in the day, IBM, Micron. And I was the semiconductor tech trader at Bank of America. I was not focusing just on Microsoft. And so what happens is each banker's book has so many names besides Microsoft, and it's hard to focus on any one name. So you're kind of managing a portfolio of options as opposed to one guy who's just looking at Microsoft and he's size up. And so Susquehanna saw a niche there to basically say, hey, investment banker, I can help you. We, Susquehanna, can help you because we have hundreds of traders in every name, okay, around the country, and they can take down some of your flow. And that was the beginning of a great idea, payment for order flow and the options. And I was using them on 50% of my trades that were coming in. And the
right.
traders, the traders thought it was such a great deal that they would pay us and help us mitigate the risk.
But that's the key on both of it, right? You think about it. No, but I shouldn't say no one. It's very, very unlikely that someone wants to warehouse the entire risk of a massive trade, right? You want to
It's
either
hard. It's hard.
part,
And before we get to that point, because that's where we got to get to next is this large trade comes in.
right,
So Susquehanna eventually became the payment for order flow in options. And then in about 2003, I believe, 3, 4, they actually switched and became a broker. So they switched and they became a competitor to all the investment
right, right.
banks.
Yeah,
and started going after everybody's customers, and that caused a little bit of a schism there. I was like, whoa.
it did. It caused it caused an uproar. Back in the day, and I have a tremendous amount of respect for what they did as a firm, but they were tough. I mean, you had some arguments, some brawls with some of the guys that were, the big guns, the guys that are within the top five, and I experienced it being on the floor with at least two of them, maybe three.
They were
Yeah,
smart, but tough. Very, very smart, fast. I mean, there's one guy that I remember, one of the fastest and supposedly one of the best Susquehanna traders on the floor. He was a rock star down there. The ability to make markets perfectly, fast, size up. I mean, he would make things, he'd be like 50 back then. Okay, let's put it into context. 5,000 options, 10,000 options back then was a lot.
yeah,
He would say 25,000, 50. There were some pits where there was these traders. I don't know how. I mean, they were just so good at what they did, and 25,000 up, 50,000, whatever you want to do. It was amazing to me. So they were very good. Like you said, they were very good, very smart. And then they became everybody's competitor. And now they're a brokerage firm.
right.
And Jeff Yaz, who's the owner, is one of the richest men in the world.
Yes.
All very smart people. So they have something there. The engine there is very, very good. But let's get to the big order, right? A big order comes in.
Mhm.
What does that look like? What are you nervous about? So a big order comes in. I say, Rob, I want to buy 20,000. I don't know. Back in the day, 20,000 Microsoft at the money calls 1 month.
Okay. And we're at the investment bank. Well,
Yeah,
the one thing is the filtration process goes through. Okay, who is it? Number one, right? Is it a hedge fund? Is it probably not a mutual fund unless they're
it's
covered?
hedge fund. It's Raj
Yeah.
Raj Raj and a gallon. He's
Uh,
screaming at me. He's like, let's go, let's go, let's go.
but number one, something. It has to be close to his heart and close to his brain about why they're doing this. And you look over at your trader and you're like, hey, I want to buy 20,000 of these at the money, whatever, let's call it.
And
Why
let
would
me ask you, what's the first thing he says to you?
who is it?
Yeah.
And
Second
yeah,
thing, is he
well,
nuts?
is he nuts? And third of all, he's like, I got to make it a little bit wider. And you would come back and you'd quote it. It might, let's say it was 75, 90, 95 or 75, 90 was the
75 cents, 90 cents, let's call it
90
on the
cents.
screen.
Right. Again, probably a little cheap for a 50 delta, but let's make it just that for argument's sake. I want to buy 20,000 and pay 90 cents. Well,
Exactly. Inside or 87. I don't want to pay the offer. That's what
exactly.
usually comes
I
in.
want to pay 80.
75, 90 is too wide. I want to pay 80,
I want
85
right.
max.
I want to pay
20,000.
and then you look at it and you convey that to your trader, which is going to come back and say, no, 90 is fair. It's on the screens. I need a
90,
little
he's
bit
going to say, I'll show you back then. 90, I'll show you 5. 92, I'll show you 10.
right,
And
right.
95, I'll show you
I'll
20.
show you the pounds, a scale up order. Well,
Yeah,
needless to say, you don't get that order.
exactly. You
A
get
couple
screamed
of,
at. You get
right,
screamed
a
at.
couple of compound phrases thrown your way, and
Yes.
about 8 minutes or 10 minutes later, you get the account relationship manager coming down and walking by you and asking he or she asking you why that we did not facilitate customer ABC on this
Yeah.
trade.
And the worst is that it went up. You just saw it go up in the market at 88 cents by Goldman 20,000 times.
Right.
And literally you're having this conversation.
Right. And you know what? There was always a fight for the revenue, the perpetuity of the flow, which clearly why we're in the business. But the single most important thing that in my time and experience with people, they didn't have a true grasp on what the risk of the trade was. They just saw whatever it was, 40,000 or $30,000 in commission go away. But the issue lies in the fact that we have to hedge it. We know it's fast money, number one. And number two, just because you take that commission in, that's not fully realized. It's not realized until the trade is closed, it's rolled, or it expires worthless. right? And
Right.
that was the hardest thing to convey. We were in the business of negative selection. Phone
What does
rang.
that mean? What does that mean to you? Negative selection? What does that mean?
So when you're on a desk and you're exposed to the entire investment community, you have some people that you know are going to give overrights, some people that want to do that want to own puts for protection, but you don't know if that's coming in as, let's say, Microsoft, Apple, or it's coming in at a really thinly traded name. I mean, I'll give you two examples. One at one firm and one at another. One time it was, I believe it was a early Friday afternoon in the summer, and a sales trader from another office calls and asks us for a market on. It was an outdoor equipment company, and we looked at him. We're like,
What is this?
he trades this stock trades 41,000 shares on the day, and you want a market on 5,000 30 delta calls. That's 4 times the volume for the hedge. And he would keep pestering and pestering and pestering. So you kind of realize that something's up, and something's definitely up. And you tell the trader, look, I wouldn't sell these. I wouldn't touch these. I don't care how many vol points over
Right.
theoretical it is. There's an an insistency to have this trade done. So it leads me to believe that stay away.
You're pointing out something that's very interesting, that, being a good person on that desk, a team player, is someone that is not just interested in getting the trade done for personal reasons to get commissions on your run, but also understanding that, sure, we might make 30,000 in commissions, but we might lose 2 million on the trade. And you want to be careful of that, because the back end will come back to you, will point right back to you, because the trader is going to say, I put this trade up, it's this customer, and we got beat by Rob Bendock's customer. And if
Right.
that sentence is repeated multiple times over the course of the next 3 months, then there's a problem with Rob Bendock, not the trader. So it's this fight between, if he makes money, if the trader makes money, the trader always thinks he's the best and he made all the money. If
Right.
the salesperson loses, brings in a losing trade, the trader's going to say, what a terrible trade this guy's bringing in, right?
And
And
that's
so
why,
that's always the battle.
and you had to be on the defensive, right? And you had to have that part in your brain that was almost like an alert to, number one, the counterparty, number two, the freak the duration of the trade. It was short dated, long dated, low delta, gives you clearly the greatest level of convexity for return. And why would this person be doing it? All right, there's no open interest, right? They're buying to open, right? And
Yeah.
what's the history? Have they done this before?
Are they good? Are do they have a pattern of being really good at what they do? And
And
is this going to go up? If they're buying calls, is this going up?
right, and guess what? On a Tuesday morning, the following Tuesday, there was a takeover announced in this particular stock.
Yeah, I mean,
We,
I've
that we
been
didn't
there. I've
touch.
seen that.
We didn't
Yeah,
touch.
I've seen that. Yeah. So
And
I have a story like that. There was a guy. He's still around. I still look at him. I still follow him. He's around. He's very good. But it was 2000. I want to say 2004, and I was trading biotech,
mhm,
and he came in at 3:45 on a Friday afternoon expiration. So context is, this thing is going to zero in 15 minutes. He wanted to buy, the stock was 98, and he wanted to buy the 100 calls. They were on the screen at no bid at 10 cents. And he wanted to buy 15,000 at 10 cents. Okay, so 15,000 options times 100, 1.5 million times 10 cents, 150 grand. So
mhm,
if the stock is 98, hasn't moved all day, it's up and down a quarter, 30 cents, and they're about to expire in 15 minutes, now 13 minutes, as I'm talking to the sales guy who's bringing in the order. And I'm saying, this obviously doesn't smell right, that there's something wrong here.
mhm.
And, but if I sold those, the factual matter is, if I sold those and nothing happened, I took in 150 grand for 12 minutes of not doing anything. Or something does happen and this thing goes up, I decided to decline the trade. I had wanted nothing to do with it and told the guy, I can't do that trade. But I did offer, he was a good customer. So I did offer like 2,500 at a dime, which I still didn't even like. But I said, I would buy some stock, to try to help protect a little bit here. No,
Mm-hmm.
no news that I was hearing. There was no event happening. Passed. The guy wanted at least 10,000 pass. Okay.
Mm-hmm.
At 4:10, 4:15, there was an announcement. They got a drug approval. The stock went from 98, I remember, to 113. And I just looked at the salesperson and I said, we would have lost $13 million,
Mm-hmm.
on 10,000 options. And if it was 15,000, we would have lost almost $20 million. And I said to him, I said, is this guy someone that we want to deal with? If he's trying to do that to us, is this a guy that's someone that we want to deal with? And that's where the decision you have to make on, does $5 million in commissions, is that worth, one trade where you can lose 20 million in 15 minutes? And that was always the battle, right? That was always the back and forth between sales and trading and just good business sense. But there were these negative selection, in my view, is you're always getting those trades that are really tough. And as technology got better and better, these hedge funds started using technology for their small orders. Okay, so you never got the small orders anymore.
Exactly. Or in the
All
highly
you
liquid.
got were these massive big orders where they wanted to take the biggest risk. They wanted to take the big shot because they felt they had the answer or close to the answer enough to say, this is great risk reward. It's either a dollar goes to five or a dollar goes to zero. I want to do this at 20,000 times. That to me was the negative selection. And that's why that job is incredibly difficult. And if you're not playing, it's almost like you are forced to play deltas, which is not what the investment bank wants you to do. The investment bank is saying, don't be playing around with deltas, be delta neutral. But I don't think that business can be run completely delta neutral. It needs to have a little bit of room to sort of follow some of the guys that are coming in. So what we're talking about is that one moment in time where the the delta is the biggest risk for the trader. And that was always something that was a fight and why the market had to be wider. Um, but I think they've gotten better. I mean, the machines have gotten so much better.
Yeah, I mean, it's been the liquidity that exists today is phenomenal, and I think most people that have never experienced what we just discussed, they'll they don't value it. They don't value the beauty of
I know. I
easy.
know.
Just you click a button and done. You're
I
filled.
know. I know.
And when they look and they oh, I did this and I bought these options and the stock went up a dollar and the options only went up 10 cents or 20 cents. The This firm burned me, this market maker burned me. Well, when you look at it, you have to fully look at the picture of what you're doing. If you're buying a low vol name, right, and all of a sudden you get a whip and the stock goes up, yeah, your call option is going to go up. Your put option probably go up a little bit too. Vol's increasing. But if you buy a call option that has historically traded 35 vol that you're paying 60 for, right? The odds of continued expansion tend to be a lot lower than they would. You've already
Right. You
experienced
lose that, you lose
massive
that second order of profiting, which is the increase in the volatility as things are
volatility.
moving. So a little bit like GameStop, when the stock starts going up and starts acting crazy, they're winning both ways, right? They're winning with the direction and then they're winning with this super high increase. That is an extreme case, but just to help people understand that you can win both ways. It's interesting the way the market has come from where you were starting off. I still can't believe the handholds. I have so many thoughts about it, but where that where that started and how payment for order flow came about, and then how Citadel jumped in and became this behemoth as a market maker. They are the biggest market maker, options market maker in the world. And I guess the question, we talk about where we came from, where we are today with penny wide options, 2 cent, 3 cent wide options. What do you want to do? Decent size for any average investor. They can do whatever they want on their fingertips. Citadel has this stigma about being this bad. Citadel equals bad. Don't like Citadel. Nobody can like Citadel because they are the enemy. And I guess the question is, what do you say to people like that? How do you help people understand that maybe they're not so bad?
When you look at markets that in certain names were, some of the options could have been 90 cents wide or even wider posted on the screens. Now that clearly isn't the market, right? There will be, if you put a bid in, or that's if it's 250 bid at 4 and you put in a whatever 3 1/4 bid, you might get hit. And the reason you would get hit is because of the electronic prowess of certain market makers that are in the market. Now, if they didn't exist or other market makers didn't exist, you would have to go, you would take the order to the floor. Your trader at the time would price it and say, I'll sell these at 3 3/4, a quarter below the offer, and I'll only sell what I have to. Now that's
Right.
because we may already have a position in that security or something that correlates highly, and we're already short vol, and we don't want to get any shorter. And the beauty of the market maker is that they're pretty agnostic because they trade so many things. The risk gets offset constantly. And
Right.
there's a correlation in of
And the
names.
machines are doing all this. The machines are doing the correlations. The machines are figuring it all out. The machines are saying, we have Coke, you're trying to do Pepsi. It's almost the same thing. Fine, we'll do that. And they figure it all out these days. It is pretty incredible. And to say you were talking about the XMI, and that was a very liquid product back then, and that was 10 cents, 10% wide. Today, it would be like trading 1 week SPY options at, $2 options,
Yeah,
say at $2 at 220, where the market today is 208, 208, 210, 208, 209 floating
right.
around. And that is something that's pretty remarkable. So the machines, starting from a handheld in the 1980s that you just told me about, to Citadel using artificial intelligence to find every correlation that's possible in the market and making a market off of those mathematical calculations. It's incredible. I mean, that transformation from wide bid offers, really no retail customer, to millions of retail customers. Somebody has to be driving that. Like I said, it was Susquehanna who was driving the institutional side, but then someone had to drive the next level, the retail side. Susquehanna could have probably have done it, but they chose to become a brokerage. Citadel took the reins and said, you know what? I'm going to step in. If it's not Citadel, it's going to be someone else. Otherwise, there is no bid offer that is going to be 10 cents wide. Somebody's got to have the machines to do that. And when it's like you have to take the good with the bad, right? And I think people have a bad taste in their mouth because of what happened with GME and shutting down the system. I know what happened, but I don't know the details. I didn't follow it as much as it was.
There were
They
vol
shut down, they shut everything down, right? They shut everything.
they were trading halts, and when the underlying security is halted, guess what? The options are halted. You can't continue to trade, or I should say, at least to the best of my knowledge, that you can continue to trade an
It's very
option
difficult.
on
Yeah,
the
it's
security
very
is
difficult.
halted. The challenge came not only with Game, but with a few other names that were halted a few days before an expiration, and there were people that owned puts. Let's say they were the 50 strike, and the stock was halted at 38, and the opening indication was $2.
Yeah,
Right. So you're looking at people that really had the potential for some real life
massive
changing,
losses.
some open trade equity that it was significant.
I always go back to, if you're using a product where there is massive players that are behind this product, that are supporting the product, yes, they're making money. They're capitalist. That's why they're doing it, right? And they're
Right.
trying to make money. But if you're going to jump into that pool, I think I think you have to expect that to some extent when things get a little crazy, they're going to try to save themselves first, right? I think that's just the way it works. If you are thinking that JP Morgan is going to go down and you're hoping JP Morgan goes down, it's probably not JP Morgan's probably not going to go down. It's an important part of the government's infrastructure of banking and commercial bank. So I think it's a lot of wasted energy to start saying this is, they have to go down. If JP Morgan and some of these banks they get taken out, I mean the whole system could collapse, and
Correct.
that has more ramifications for the personal life of everybody trading
Everybody,
than
right,
just, so I think you got to be careful what you wish for, because if
right,
you want to be able to trade anywhere, somebody's got to be making that market. And yeah, that person and that group, Ken Griffin, they're making a lot of money,
right.
billions of dollars.
But
But
it's
if it wasn't them, it'd be somebody else.
somebody else. But the beauty of that is that it doesn't lie with one transaction,
Right.
right? And that would be my assessment of how it's done. You're not going to make one big bet to make the money. You're going to have countless bets, long this,
Right.
short this, long this vol, short that vol, whatever the case might be. And in that, by capturing the spread and the appropriate hedge and knowing when to stop selling or can stop buying or can buy more or increase your bid, whatever the case
Right.
might be, that is all through the calculations that they utilize to run their business, which is, again, we both agree, incredibly successful and talented. But the thing about emotion is when I've listened to and I've spoken to some folks that they get really, really emotional about not only their position and the security, but those that are involved in it, the management, this and that. And you may have a point that someone's not a great manager or someone's not this, but the aspect of trading is to remove your human emotion from your decision making. There's a point, trust your gut, which I agree with, but you can't. It's really a challenge to be vexed, either overly positive or overly negative, and
Right.
wishing, hoping that the security moves in the direction that
That's
you
right.
think it will. Here's what I'll give you the best one. Last year, maybe a little bit more. Coinbase, it collapsed. We all saw it, got hammered. It got down to like I think it was 42 or $40. And I was listening into a chat room where there were participants that were vehement about this going to zero and about how the management should be punished. And I'm like, well, they kind of been punished already, right? The stock went down. They probably got a lot of money in there. But what was a really, really mind blowing and eye opening was that the stock was 42. Let's say the 35 puts out 4 weeks. People were paying $5 for them, if I remember correctly. And the skew, which was normally to the put side by small,
Yeah.
was now the put was pronounced by, I think it was 3.5 or 4 Z scores. Right. So what that means is it doesn't ever get this expensive. This is a real eye opening moment. So you could have sold the 30 puts, which were $12 out of the money. You could have sold one of those and bought the 55 or 60 calls. You could have bought 6 or 7 of them.
Wow. Wow.
And a lot of this is because sentiment, right? And we discussed this before about social media velocity, right? On the calculation methodology for options. It doesn't play the same as the true math, but it'll show you where the sentiment is. If sentiment
Yeah.
is really high, guess what? And it's bullish, calls are going to go up. You can buy the call, stock could go down, and you're still going to pay more,
Right.
right? And that is the part where it's most difficult. It's an emotional game, and
Did you see the 60 minutes on Citadel? I think it was 60 minutes or 2020. I think it was 60 minutes. So they showed, it's a must watch, just if you want to understand how fast this thing is moving, this monster, if you will. It has nothing to do with humans anymore. They showed the opening bell at 9:30 on any given day, and they showed how the orders came in to Citadel. So they showed Citadel's computers, and they had a couple people monitoring, and one guy's at the desk, and they just showed the computer. And the amount of orders that were coming in, it was like lightning fast. And I mean, it's all computers. When I looked at that, it gave me a good appreciation of this is no longer humans. You know, humans can have a little bit that the human is telling the computer this is how we want to make money, but you're gonna learn and you're gonna do it, and it's AI and it's a beast. And when you see this, there's no human involved anymore at even, levels 1 through 5. It's like the human is basically saying they'll get on the machines if something starts going wrong, and they'll say turn the machines off, almost like trading places, right? It's like turn it off, and I think there's something I picture a George Jetson with like a backpack on it, a knapsack with a big battery and a handheld running around, Thomas Batterfie's lackey on the floor, to this AI machine that I saw on 60 Minutes, and that transformation is incredible. And it was a tremendous journey. It has been, and I'm curious to think about where it's going next. I don't have any ideas about that. Do you have any ideas of what you think the next thing is? 24-hour trading? I mean, they're talking about this.
Uh, I mean, what you and I, when we were on a desk, our biggest concern is the inability to access markets when we have positions, large positions. And let's say this just goes towards equities at first, and options are, on single stock and index options or ETF options are further on down the line thought. But let's say we're long puts in ABC, and over the weekend something happens and ABC's down 4%, right? Well, we can't sell our puts until Monday's opening. But if we want to buy some deltas down at this point, all right, maybe we can do some. So I think that there is a benefit for it for certain participants. My fear and my concern is that it really increases the opportunity for people that can't put the button down. I can't put the mouse away for
Sure.
48 hours. And
Sure.
I don't know. It's almost like the same thing as online gambling, right? You put it down, you go back, you're like, oh God, I just did really well.
Sure.
Let me go back again. And guess what?
Sure.
Maybe you made it, maybe you lost it. But from a hedging standpoint, I do think it makes tremendous sense and gives people that are involved in the derivatives market or have nonlinear exposure convexity to be able to go in and buy or sell securities,
To hedge themselves a little bit.
hedge their portfolio. I think
Yeah.
that's good, would be a really good outcome for that.
Awesome. There's a lot to be learned from how orders would come in, the pressures that we experienced. Um,
And closing it out, the greatest thing I think you share with me is we learned from some really, really, really smart people.
yeah,
And
absolutely.
the beauty of it was not that they were PhDs in applied math or statistics. The beauty of that mindset was that they could distill it to a very, very simplistic and understandable level, which gave me, and I believe you as well, a foundation to build on and approach more of a mathematical level. But that ability to teach and to teach options and to explain to people what they can do, what they can't do, what risk is, what it's not, but that's the single greatest thing that anyone that wants to get in this game and play it, they have to understand.
And you can't learn it from a book. I'll
Can't
tell you
learn
that.
it from a book, and
You got to learn it from these stories. That's where you learn the most. Like you learn from experience and from these stories. I'd like people to understand, because you can understand the Greeks and the delta, the gamma, but if you really want to understand it, you got to listen to the times where the models don't work, and it becomes more of a street smart. intuitive game where you have to rely on instinct and rely on what's smart, what's right. How do I hedge? How do I not blow up? How do I save myself? How do I save the bank? It may not have to do anything with a model. I can tell you that much. And the
Exactly.
model may be telling you to sell something and you're there buying it because that's the right thing to do. Um, all right, Rob. Until next time, what do you
Yeah.
say? All right,
Look,
I'll see you
looking
later.
forward to it. Thank you, Felix.
That'd be good.
You too.